Is Nextracker at $39 a buy? That's what I'm going to cover in this video. In doing so, I'm going to cover its business model, financials, and finally I'll do a valuation. Let's get started with the business model. Nextracker is an energy solutions company that provides solar tracker and software solutions for utility scale and distributed generation solar projects in the US and internationally. They have multiple products. More importantly, they have solar trackers, foundations, software and controls. Within the solar trackers, their flagship product is NX Horizon, and then there is Alter and NX Horizon XTR. They are very popular, and they also have NX Foundation solutions, and they could get that using an acquisition in the recent years. And in summary, they actually help large utility scale solar projects with efficiency and maintenance. So that's what they do. Now let's move on to the financials. As you can see on the screen, the market cap at $39, stock price is $5.66 billion, and the past 12 months they made a revenue of $2.8 billion. So that's a price to sales of 2, which is very cheap in general, but we cannot look at price to sales in isolation. Let's look at the PE ratio. It's 9.76. That's also considered cheap. Even the forward PE of close to 13 is also cheap because this company is growing in double-digit percentage. This company is already profitable and it has a great balance sheet, which you will see just in a bit. What I'm thinking is this company is having such a low PE ratio because the market is thinking that the margins are going to drop and their growth rate is going to drop. But we'll discuss that in the coming minutes. Let's first look at its margin profile to see how profitable this company is. In the most recent quarter income statement, as you can see on the screen, they made about $635 million of revenue and the gross margin is 35%. In general, 35% gross margin is low, but look at the operating margin and net income margin. That's 21% and 18% respectively. So that tells me that Nextracker is very disciplined with respect to their operating expenses. I have personally noticed that in the past few years they increased their revenue by close to $1 billion, but the operating expenses only increased by $100 million. So that tells me that they're very, very cautious about their operating expenses and they want to keep it light. That's actually very good because this company has low margin, and for them to get a good profit, they need to control their operating expenses. And at the bottom of the screen, I wanted to look at its dilution. This company is already profitable, so the dilution is not significant. A year ago, they had 147 million outstanding shares, now 149 million outstanding shares. So that's negligible dilution, so I don't need to worry about that. Now let's look at the balance sheet. They have close to $560 million of cash and cash equivalents, and long-term debt is only $140 million. So that's a very healthy balance sheet. With respect to outlook, they said they can grow about 14% year over year in financial year of 2025, and that represents $2.8 to $2.9 billion of revenue for the financial year of 2025. So that's a double-digit growth. And they also mentioned that they have close to $4.5 billion of backlog, which means that those are some orders that they are not able to fill yet, and they have to fill those orders in future, and the order book is growing. So that tells me that they can still grow at a double-digit pace unless something drastic happens, right? So now let's look at the valuation. Before I move on to the valuation, I want to clarify that this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts about Nextracker. I just started a position, just 20 shares at about $36 stock price. That's what my initial purchase is. I'm going to watch this company in the coming quarters and I'm going to keep on adding to my position. So let's look at the valuation. I'm going to show two cases, one with reasonable assumptions and the other one with great execution. In the reasonable assumptions case, I'm estimating a growth rate of 8%. Remember that in the most recent financial year, they are saying they can grow about 14%, and they also have $4.5 billion of backlog. Yet I'm assuming 8% because it seems market is thinking that their growth rate is going to drop. That's why I put 8%. And the net profit margin, I'm only assuming 15%. Currently they're at 18%, And as they grow bigger and bigger, their net profit margin has to increase because they are keeping their operating expenses in check. The revenue is increasing significantly, but the operating expenses are not. So the profit margin has to increase, but the market apparently is thinking that the profit margin is going to drop. That's why I'm putting 15%. Otherwise, I would have included like 20%. So I'm giving a multiple of 17.5 because I think once the negativity on the solar industry disappears and Nextracker proves that they can grow in high single digits and maintain the 15% net profit margin, people will pay 17.5 multiple, with which this company would be worth about $10.8 billion in 2029. And this company barely diluted the shareholders. They're already profitable. They're making close to $400 million of profit a year. So there's no reason for them to dilute the shareholders. So that's why I put 0.5% dilution, with which this company will have 149 million outstanding shares in 2029. That results in $73 stock price. Currently they're close to $39, right? So that's about 91% gain in 5 years, and that's definitely attractive. Also note that I did not consider cash because each year this company is making $400 million of cash. In the next 5 years they'll make $2 billion. And that cash is owned by the shareholders. They can either give it back to us in the form of dividend or buy back shares, or even do another acquisition to increase the revenue and profit. But if I consider that $2 billion of cash, if I divide with 140 million outstanding shares, I get another $15 added to this 73. So I think it's going to handsomely double in the reasonable assumptions case. And in the great execution case, I assume 10% growth rate, 17.5% net profit margin, and a 22.5 multiple. If that happens, the stock price would be about $119, and that's actually triple from the current price. And remember that I'm not considering cash here. So overall, what I would do is buy this stock. I do not see too much downside. I like the risk reward. So as I said before, I only started my position. I'm going to observe this company in the coming quarters, and I'm going to keep on adding. Again, I'll keep it to 5% of my portfolio, which would be about $5,000 to $7,000, in between $5,000 to $7,000, because I don't want to expose myself to a lot of risk by adding a lot of shares of a single company. Let me know your thoughts in the comments. Thank you so much for watching.